Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Thank you, Ashley. Good afternoon, everyone. My name is Evan Bradley, and I'm the CFO here at Campbell Property Management. I'm also one of the 5 partners of the company. I'm a licensed CAM, and I work very closely with some of our largest clients on the major issues facing their associations. And unfortunately, for most of you, that one of those issues has been insurance over the last few years. So those of you who may not be as familiar with Campbell, we've been in business since 1953. We manage over 400 HOA and condominium association clients in Dade, Broward, Palm Beach, Martin, and St. Lucie counties, all here in South Florida. With us today, we have 2 special guests. We have Paul Mack and Chad Tiernan, both of Assured Partners. They are experts in the field of condominium and HOA management. They are going to talk to us about market trends, what to expect, and maybe some things you can do to help your association. So Paul, Chad, do you want to introduce yourselves and your firm a little bit?
Thank you, Evan. It's great to be with you again. Thanks for having Chad and I on. And yes, those of you that don't know Assured Partners, we are community association insurance specialists. We have over 3,000 communities in Florida, and community insurance is our thing. Again, really appreciate the opportunity to be on here with you, Evan.
Thanks, Paul. So just quick reminders, this is not, this is informational purposes only. This is not legal or insurance advice for your particular association. If you do need specific advice for your specific situation, please reach out to your community's agent and your association attorney if you're looking for that type of advice. I also ask you to take advantage of the Q&A, but try to limit it to the questions about the material being presented. Questions about your individual personal insurance situation or legal situation are going to be beyond our scope today. So quickly, here are some introductions for Paul and Chad and their contact info in the event you want to reach out to them. And do keep in mind, we'll be sending this out after the presentation, so you will all have access to this if you want to look it up later. So what's on our agenda today? We're going to start with what are the basics of association insurance. Purchasing insurance for your association is very different than purchasing for your home or your vehicle. It's not entirely intuitive, so we're going to talk through that for a second. Many of you on the registration, probably why most of you are here, is wanting an update on the state of the market. Part of that update is clearly going to be roof age and mandatory replacement issues. Some of you are dealing with that, and some of you who haven't maybe soon. Electrical panels are another major issue that are being addressed at the insurance level. There's also been some flood map changes, so we'll talk about what to expect for this year and beyond. There are some ways to potentially reduce rates, although they do come with their own costs. There has been some legislation that may have helped some. And we'll talk about how to deal with increases when it comes to communicating with your residents. And if there's any time left, we'll get into a Q&A. So starting off with the basics, what are the main types of insurance that all associations need to carry, Paul?
So, Evan, most associations, whether they're condominium associations or they're homeowners associations or even co-ops, need to carry what we like to call the traditional insurance policies, and they are a property insurance policy that covers all of the improvements, such as in a condominium, the residential buildings, and in an HOA, it could be a clubhouse, it could be other auxiliary improvements like tennis courts and guardhouses and things like that. And those property insurance policies cover perils such as fire, lightning, and windstorm, which windstorm is predominantly driving costs here in South Florida. So that's known as a first party insurance policy because it's covering the assets of what the association has to insure. We also see third party policies like liability insurance, general liability insurance, and that picks up risks associated with trip and fall hazards. So, most communities have common area like parking lots and tennis courts and things like that, swimming pools, and any kind of premises type of exposure that exists. And if the association gets sued, they would have to hire a lawyer to defend them. All of that is encompassed in a general liability policy. We also see directors and officers liability. So in contrast to general liability, directors and officers liability insurance covers the board and the management company or the managers for, in its simplest definition, is management malpractice. Somebody alleges that the board or the manager made a bad decision and they take action, picks up legal fees and costs of settlement there. And we have statutory requirements for fidelity insurance. So the association is collecting all these funds to pay vendors regular assessments, and sometimes for special assessments for capital improvements and projects like that. That money goes into the bank or a conservative investment. The state requires that money is bonded by an insurance company in case it's stolen internally or a third party gets in there and hacks in and steals that money. So we have to have a fidelity policy. And oftentimes we see an umbrella policy. And an umbrella policy covers, God forbid, a catastrophic claim, because the general liability that I mentioned previously about slip and fall, and the director's insurance where we have management malpractice exposure, those policies typically provide $1 million limit. And then those limits are exhausted after the insurance company has expended $1 million to defend or indemnify a claim. So you buy an umbrella that covers over and above if there's ever a catastrophic type of a claim, wrongful death, some type of serious injury like that.
Right. And then flood we'll talk about more later. Not everyone has to purchase flood, but flood's another one too that can be in there depending on where you are on the map, and there have been some changes there. So we'll get into that. So what is the role of the insurance agent? And we'll kind of combine these, and how is the insurance shopped or bid out? Because I think this is a really common misconception in our industry, because it's very different than homeowners or auto liability.
Very different, Evan. And this I would say is probably the number one misunderstood process about acquiring insurance. So let me kind of dive into this. The role of an insurance agent is multiple. So first of all, I think it's important for everybody to understand that the insurance agent is not the insurance company. The agent's role, a good agent, his or her role is to help the association really interpret what they're buying. Also put together the information, send it out to the insurance companies. So what we call a submission that goes out to the marketplace. And the agent is the association's conduit to the insurance company. No insurance company can sell an insurance policy unless it's through a licensed insurance agent. Now, some insurance companies have direct agents, but for purposes of our discussion here with associations in Florida, you're going to need to go through a licensed, most likely independent agent to acquire the insurance that you need. And again, that role is to help the association make the best buying decision that they can. Help them interpret the policy. We are in an environment where we're dealing with a lot of non-standard companies that put exclusions on there, and oftentimes there's exclusions and limitations that the association doesn't know about until it's too late.
Mm-hmm. Okay. So how does the association know they're getting the best deal, or that the insurance has been properly bid out by their agent, since they're kind of beholden to an individual agent?
Yeah. So, everybody right now wants to shop, and understandably so. I mean, last year, what happened in the insurance market for communities in Florida is unprecedented. I've been doing this for 30 years, and never did we see anything remotely close to to what happened last year. So, to answer your question, how do they go out there and shop? So what oftentimes a community thinks is, well, hey, I'm going to go out there like I bid my auto insurance or my homeowner's insurance. And, many board members coming from a different state don't understand that there's a fairly limited market here in Florida. And, hey, you go out and you talk to agents, and one agent A will go to 5 companies and agent B will go to 5 companies. And, the best program wins. But here in Florida, we don't have that kind of capacity, particularly when it comes to property insurance, where we have that many bidders. So typically an association will go out to the marketplace, talk to 2 or 3 agents, and inevitably an agent will say, well, I need you to sign this letter, known as an agent of record letter, so that I can go out and get you quotes. And what that does is it authorizes that agent to go to the marketplace, because insurance companies will only deal with one agent at a time. So we recommend that an association go out there and talk to multiple agents. There's nothing wrong with doing that, but understand that in Florida, in this limited marketplace, most likely agents there's going to be a big overlap, and agents are going to want to go to the same sources. So what an association should be doing is interviewing an agent and finding an agent that they think is going to be looking out for their best interests, that's going to be transparent with them throughout this process, that may also document, hey, what can I expect? We like to go out to our clients and say, if you hire us, this is what you can expect. And this is a timeline of what we're going to do and when we're going to do it. Because too often I get calls at days before an association renews and says, we just got hit with a 50% increase, 70% increase, and we had 1 or 2 days to make this decision. And it shouldn't be that way.
Right. So the term we hear all the time, and it's tossed around like everyone knows what it means, but I bet a lot of people don't, is this is an admitted carrier or a non-admitted carrier when you're getting your quotes? And what do those terms mean? Because they're incredibly important.
Yes, they are. So we'll go over a couple of big differences between admitted and non-admitted. So, and there is a place in Florida right now for non-admitted carriers. So first thing I want to say is non-admitted carriers are not bad. They're not taboo. But an admitted carrier is a carrier that if you have a choice between the two, where you got a bid from an admitted and a bid from a non-admitted, you probably want to look at the admitted carrier first, because that admitted carrier, their forms, and they're subject to a higher degree of regulation from the Department of Insurance. And the logic behind that is the non-admitted carriers are not going to be subject to that same degree of regulation, because they're going to need flexibility. They're there as a backup. They're there as sort of a secondary market when these admitted carriers don't want to write the business. And I can give you a whole host of reasons in Florida why they wouldn't want to write business. Legislative environment, regulatory environment, hurricanes, prior loss history. We got a lot of lawyers that like to sue people in Florida. So for all of those reasons, there's a very vibrant non-admitted market. So when you're dealing with an admitted market, you're dealing with forms that are vetted by the Department of Insurance. And when you're dealing with a non-admitted market, they're not. So again, that's where, getting back to the other thing, what's the role of an insurance agent? The role of an insurance agent is to look through those forms and, on your behalf, the association's behalf, negotiate whatever they can get out of there that could be a hazard or could be a limitation of coverage, and not just buying the cheapest price that you possibly can. I realize that there's tremendous pressure on associations right now to lower costs, but you've got to make sure that your agent understands what the policy is excluding or what the limitations are, and more importantly, that they explain those limitations to the association. Last issue on admitted versus non-admitted, big issue here is the admitted carriers participate in what's called FIGA, the Florida Insurance Guarantee Association. So if an admitted carrier goes belly up, they go bankrupt, like we had in 2022 and 2023, we had 8 admitted carriers that went bankrupt. And the state stands behind those policies for any unpaid claims and any unearned premium that would be due back to a policyholder. So another big difference between the two.
Right. All right. So there were several questions in the registration about self-insurance, partial insurance, and so Paul, you want to talk a little bit about, do associations, particularly condos, have to insure for the full value of their association?
It's a big issue right now because in the wake of Surfside, happened a few years ago now, but prior to that, insurance companies have been complaining that the replacement values that we're insuring, because most associations go out and get a third-party independent appraisal for the replacement valuation. Well, they've been complaining that those values are too low, and they're not real. They're just, they're numbers that don't represent what the true replacement value is. And when Surfside collapsed, the building was insured for $30 million, and the actual replacement cost was $90 million. So there became a heightened awareness with underwriting, with replacement values, and it's a big issue right now because every property insurance carrier is looking very hard at what we call ITV, insurance to value. And they're looking at those appraisals. They're looking at the replacement cost per square foot. And if the insurance company is not satisfied with it being adequate, they will, behind the scenes, make a higher rate to account for an inadequate replacement value. So it's a big issue right now in underwriting.
Right. And it is outlined in Florida Statute 718, and it's outlined in many of your association documents as well. You can see it here that full coverage, is part of the requirements. So a lot of people, I think they use the term self-insure when they really mean not purchasing any insurance. And as far as the statute and the documents go, again, I'm not a lawyer. You can run this through your attorney, but from what we see, you are not allowed to do that. There is a complicated method of self-insuring that involves other condominiums, reinsurance, but it's way beyond the scope of what we can talk about today. It's a process that has to be approved by the state. That's not what I think you guys are referring to when you ask about self-insurance in the registration. So moving along, state of the market update. Everyone wants to know, I think we know why we've seen large increases, but are the increases starting to slow down? And are more carriers coming into the market now? Yes.
That is a sigh of relief. I think things are slowly improving. Last year, as I mentioned, we saw unprecedented increases. I mean, as much as 300% in rare cases, but I would say in average, we saw between 40 and 70% on a regular basis, which again, could be compounded by replacement values going up with an appraisal. So I think we are past the peak of these rate increases. We have seen a limited number of carriers come in. I mean, I watch the news, everybody does, and we see that, hey, these carriers have been approved to write business. Most of those carriers, I say most of them, are writing individual homeowners policies. But we do have some new commercial capacity out there. A lot of the existing capacity that's out there now, companies like American Coastal, Heritage, Frontline, all these carriers that have been, a staple in Florida for a long time are gaining more capacity themselves because they buy what's called reinsurance, which is insurance for the insurance company, and they're gaining more capacity. So we're seeing existing capacity with existing carriers increasing, and simply put, supply and demand. Rates went up so much last year, in part because of what I mentioned, but also in part because there was nobody writing, and the carriers that were writing were getting what they wanted, or they weren't doing it. Well, we're seeing a difference. We're seeing, I'm pleased to tell you that I have a renewal coming up in a couple of weeks with an association that took a big increase, and this year their increase is 9%. And when they asked me to budget last year, I said I don't think it's going to be less than 20. So there's kind of an example of what I mean by things are getting better. I don't think we're going to be flipping a switch here and we're going to go back to, rates that we saw 5 years ago. It's going to be a slow and steady recovery, hopefully.
You touched on this a little bit on the last slide, but I mean, inflation has been rampant. Although it's cooling, it's still higher than I think people want it to be. It's particularly higher here in South Florida than the rest of the country. How's that affecting these appraisals and the replacement value assessments?
Yeah. I mean, we don't have any kind of standard that, every all these associations are on the same kind of rotation to get appraisals done. But when those appraisals are 36 months old, then they're due to be updated. So, hopefully this inflation is kind of cooled a little bit. But, last year it wasn't uncommon to see a 40% increase in replacement values. And we've seen that kind of cool to, I'm seeing more in the 20 to 25% range is more the average now for an increase in appraisal. And, hopefully all these associations that once we get through this 3-year cycle and they're adequate, we're not going to see these kinds of inflationary numbers, just normal inflationary numbers of, 5% or so.
Right. They've predicted a very active hurricane season, although I'm not sure how much faith I put in 6-month forward-looking forecasts. But should we have a difficult hurricane season, what impact do you think that may have on rates?
Yep, it's always a big factor. I think that these predictions and these come out, which I don't think in the particular market where we are now with things recovering are going to have an impact. But if we do get hit with a storm and it puts pressure on the reinsurance market again, then that could definitely take us off the recovery track that we're on. So let's just hope that if we do get a storm, Florida doesn't get hit. And even with all the, I get asked all the time, hey, Florida hasn't really been hit by a storm. Well, South Florida hasn't really been directly hit by a storm. Why are we having to pay for this? The West Coast got hit, the state and other areas got hit. But even when other areas of the country get hit, it affects what reinsurance capacity gets put out. And because we're in a catastrophic area where we need to buy that reinsurance, it directly affects how much capacity we get here in Florida and what the cost of that is.
Sure. So, a lot of our conversation has been around wind insurance and property insurance, but what are you seeing happen to the other lines of coverage, particularly for our HOA customers, where maybe their liability, D&O, and umbrella are even a larger part of the premium than property?
Yeah, there's always a big discussion on property because generally, like you say, for condos, it's the biggest driver of the cost. But for HOAs, in South Florida, it's been a problem. And on the liability side, the general liability side, it wasn't uncommon to see an HOA get a very large increase in their liability coverage. And that's still going on now. I guess fortunately it's not the largest cost item, but it is a problem in Florida. I don't think you can drive a couple of miles down 95 anywhere in Florida and not see a billboard for a lawyer that wants to sue somebody. And liability rates are a direct factor of what cost of claims are. And the frequency has been rising, and also the severity or the cost of claims is also rising due to what's called social inflation. And I don't think we got a whole lot of time to dive into something as specific as this, but quickly, social inflation is the increase in the cost to settle claims. If it costs $30,000 to settle an auto accident involving soft tissue, now it's costing $90,000. And due to just the cost of that going up, that's a big factor in liability rates. So those have risen sharply. Hopefully they won't continue to rise at the same level. Things will start to level off a little bit.
Sure. And we're going to talk about exclusions next. So, one of the things that's happening is that exclusions are being added. So you may be buying what you think is the same coverage, but you've actually had coverages removed from the policy from last year. So why don't we move over to that and kind of, can you explain exclusions a little bit and why they're so important?
Yep. Chad, why don't you pick up some of these exclusions and talk about them a little bit?
Yeah, so some of the main ones I think that are good to look out for are animal bite, assault and battery, firearms, and abuse and molestation. So animal bite really applies to if you have a dog or a cat or any type of animal in your community and they happen to harm somebody else, and there's a lawsuit or something like that that comes out of it, then the association would not be covered if they were pulled into that lawsuit, if something happened with that. And kind of just the same thing with assault and battery. If there's some sort of altercation or fight where someone's hurt, and again, there's litigation, the community is not covered if they're pulled into that. And then the same thing with firearms. If someone has a gun and something happens, and then abuse and molestation is more specifically focused on sexual abuse and that kind of thing. So those are kind of the main ones to look out for. And then Paul, if you want to talk about warrants.
Sure. Yeah, and just to add to what Chad says, those four exclusions or could be limitations in the policy tend to present a very severe exposure to the association. So all insurance policies are not created equal, nor are insurance agents. And when an association puts a tremendous amount of pressure on an agent to lower costs, oftentimes what will happen is this inferior non-standard carrier or non-admitted carrier that we talked about will put forth a quote. And unless the agent that quoted this is very transparent about this and, well, oh no, it's the same form, it's the same liability, you're in for a big surprise. So I think there has to be a high degree of trust and confidence in the agent that you choose to go out there and shop. Price is important. I get it. But you need to understand what you're buying because, as I said, they present a significant exposure to the association if you're sued and not covered. And then, some of these warrants that are on policies, they'll put warrants on a policy right now. A big issue, which we're going to get into, are these fire panels, aluminum wiring, things like that exist where the underwriters say, well, you sent us an application, but, if any of these conditions exist in a policy or in a community and there's a claim resulting from it, we're not obligated to cover you for that. Things such as a swimming pool. If your gate doesn't function, if you don't have the necessary safety equipment, if you hire contractors and they're not insured properly and they cause a loss, they're not going to cover you. So things like that are there's tons of hidden exclusions in a policy. And again, if you're looking solely at price, you could be in for a surprise down the road.
Yeah, and one of the reasons that these exclusions are happening is because they are common and they are costly. They're not taking out things that rarely happen. They're taking out the things that they are seeing happen that are costing the insurance company money, which means they're somewhat likely to happen to you potentially. I saw some questions in here about, does this only apply to pets or ESAs, and how could the homeowners association of the condo be dragged into an issue where a private homeowner bites another owner? And I can assure you from doing this that these plaintiffs' attorneys are extremely creative, and they are more than willing to bring in the association if there's any remote way that they can, and they very often find a way to do that because they know the association can afford to pay for the claim. So I see associations get brought in on dog bites, assaults, all these things that occur between two owners, but they blame the association for all sorts of things. So you will get dragged in because you have deeper pockets, is the short answer. So this is another huge issue that popped up about 2.5 years ago, and it's still ongoing, which is mandatory roof replacement due to age. So tell us a little bit about what's going on here, Paul.
Yeah. So this is a big issue, primarily because if we rewind back a few years ago, the state legislators, in an effort to protect consumers, I think the legislation that they passed was good intentions. But what happened was they said to insurance companies, hey, if your policyholder sues you, you as the insurance company not only have to pay your own legal fees, you got to pay your policyholders legal fees. And again, in an attempt to make them act in good faith. What does this have to do with roofs? Well, when they passed that legislation, I'll call them predator lawyers, but they're aggressive plaintiff lawyers, went door to door with roofing contractors and said to homeowners, property owners, hey, your insurance company is going to pay for your new roof. If you don't think there's hurricane damage, we don't really care because we're going to sue them. And if when we do, they got to pay your legal fees. And they're going to settle and they're going to give you a new roof. And that's why 8 insurance companies went bankrupt. In part, why 8 insurance companies went bankrupt in 22 and 23. So fast forward to now, and why are they looking at this? Because it's a big issue. And the reason those lawyers were able to do that was because if the roof is old, it's really tough for the insurance company to defend a claim that this was damaged by a hurricane, but really the roof is just old and it's old age, but it becomes very costly for them to defend this claim and it becomes difficult for them. So what do? They have to settle because that's just the way the legal system is. And now they've just said, if the roofs are old, we just don't want the exposure. Citizens, for example, very strict guidelines. They make you do roof inspections. And even if the roof inspection comes up that it's adequate, I can't tell you how many times people say to me, hey, we maintain these roofs. They're in great shape. We shouldn't have to replace them. They don't leak. But there's a difference to an insurance company between a roof that's at the end of its useful life and a roof that doesn't leak. And it's very difficult because it's very expensive to replace these roofs. But insurance companies are put in a position to where they can't take the risk right now.
Now, do you see that getting better perhaps with some of the new carriers coming into the market, or you don't feel like that may be changing?
No, I think the carriers that are coming into the market and the capacity that's out there now, they're very select. If your roof is old, there's not a whole lot of choices that you have. If it's at the very end of its useful life, it's not likely Citizens is going to offer a quote. They're going to decline it. Mm-hmm. And if you're a new application to an insurance company, whether new in the market or the staple markets that are out there, they're not super aggressive on older roofs. If the roof's been updated and replaced in the last few years, then that's a different story. I don't see that changing much.
Got it. All right. So electrical panels is another thing that the insurance companies have been very proactive on, I'll say. So let's talk about that for a second.
Yeah, Chad, why don't you talk about this a little bit?
Yeah. Okay. So electrical panels, like Evan said, insurance companies have kind of taken notice of this, that there's certain brands of electrical panels out there that have been deemed unsafe and they ultimately just need to be replaced. So the main brands are FPE Stab Lock, which were put in place between 1950 and 1980, and then Zinsco, which were popular in the 1970s and were rebranded as Sylvania or GTE Sylvania. So both these panels can cause electrical fires and lead to serious injury and damage. So really, if your building was built during the above time frames, or really just everyone should check to see if you have these brands of electrical panels, because it's a big risk. And insurance carriers, if they ask for it and you do have it, then you could potentially lose coverage, or they're just you're not going to be looked at these new carriers that are asking about these panels. So definitely urge all communities to check if you have these brands.
Yeah, and in addition to that, Evan, we're seeing this on both the property side and the liability side, because it's a life safety issue, particularly in communities. A lot of liability carriers in communities that are 55 and older are a hard no on this. So, what can happen is you can go out there and get a great liability policy, and then the carrier does an inspection, finds a panel, and wants to get off of it. And now you're kind of backed into a corner because they're going to not give you a whole lot of time to replace this. So, certainly don't want to add additional costs to communities right now having to deal with milestone inspections and roof replacements and everything else. But this electrical panel issue has jumped up to a front burner issue and is being looked at across the board by a lot of carriers.
Before we move on, we did have several people ask what is the useful life of a roof that you're seeing the carriers accept or whatever. What's kind of the standard?
Yeah, depends on the roof type. So, you have a lot of different roof types, shingle, you have tile where you have a pitched roof. And then you have your, flat roofs in the bigger buildings. So it really depends on the type of roof that it is and also the maintenance. So, you're going to have to do a roof inspection, and depending on how that roof was maintained, if there's water puddling and things like that, most oftentimes you're going to be required by Citizens to get a roof inspection, and you can see on there what that is. And Citizens does have their own guidelines. So if anybody wants to know specifically for their roof, we'd be happy to show the Citizens guidelines. Reach out to us, Chad or I directly, and we can help you with that.
So flood maps are now changing in Broward County. So what's going on here?
Chad, you want to take this one?
Yeah, sure. So essentially, flood mapping is used to kind of categorize certain areas into what are called special flood hazard areas, which are essentially just areas that are at prone to a higher risk of flooding. And so in this map, you can see on the left is the current Broward map, and on the right is the new map that's going to take effect July 31st, 2024. And really, at a first glance, kind of what we're seeing with these maps is some of the areas in Pompano, Oakland Park, and Fort Lauderdale. If you're in between I-95 and US 1, some of those areas are getting moved from not being in a special flood hazard area to being put in a special flood hazard area. And then kind of the same thing down in Miramar and Davie and the bottom of the community or of the county there. So really, you should check with your current agent to see if you are in a special flood hazard zone right now, or if you're going to be moved into one, because the main problem with this is if you have a mortgage, then mortgage lenders are going to require you to have flood insurance. So, that could pose a problem if you suddenly get thrust into one of these zones. So this is something to keep an eye out for and check with your current agent about.
Okay. So what's going to happen over the next year or 2 years here, Paul? What is your expectation, and what should people be thinking of in terms of increase? I think that's everyone's biggest question.
Yeah, it is. So there are some important metrics that we discussed to make sure that the community understands to really drill down on how it's going to affect your specific community. And those things are what we talked about. Valuations are key. If your appraisal is coming up and it's 3 years old or even older, that's going to be a significant driver of cost in 2024 and beyond. Or if you've done it and it's coming due next year, so know when that is, and look at those values. Have a discussion with your agent and see where that valuation is. What we call, as I said, ITV, insurance to value. See where that cost is per square foot. That's a really key factor. The other thing to look at is your current rate structure. So what the insurance companies do is they take the amount of insurance that you buy in that appraisal, and just for simple down and dirty numbers, take that number, divide it by 1,000, and multiply it by the company's rate per 100. So we could take a look at that number, and that number on an average, depending on your roof age, this is the other factor now, depending on your metrics, the ages of your building, what kind of updates have you done? Do you have impact glass? Are the buildings fully protected? How old are the roofs? All of those factors. But that range, depending on those, should be anywhere between, on a low end, $1.20, and on a high end, maybe 2.00. You take your valuation, divide it by 1,000, and multiply it by those rates. So you should be somewhere in that range, right? If I see some that are under $1, it's a red flag. Hey, these are under 1.00, and they're due for an appraisal next year. That's probably going to be a significant increase. On the contrary, I look at it, hey, your rate's $1.75, your valuation's good, your roofs are in pretty good shape, they're not terribly old. We should see a very reasonable, modest increase this year. I'm not seeing anything flat yet, but as I mentioned to you, that one that was 9%, certainly encouraging from where we've been. So, and then what Chad mentioned, that those floodplains, those remappings. So don't get caught off guard by that. If you're going to be forced into a flood zone, probably going to be forced to buy it. It's not as expensive as wind, but it's going to increase the cost. So just don't get caught off guard there. Right. And of course, the electrical panels too.
Mm-hmm. So co-insurance is another term that I think is very confusing. Are you seeing co-insurance being added to these wind policies?
Yes, they're still very common to see, and again, it's driven because these insurance companies want to protect themselves if the association is not buying an adequate replacement valuation or ITV. So we can talk about how co-insurance works. There's the slide. So valuation being $15 million in this case, you're required. It doesn't work like health insurance. You're required to carry 100%. Right. But if you carry 10 million, well, you're not in compliance. You're off about a third. So in simple terms, you're going to pay a third of a penalty is really how that co-insurance penalty works in a simple definition.
Right. So in this example, if you have your property appraisal said 10 million, but the real value is 15 million, and you have a 5% deductible for the storm, it's a named storm, and it caused $1 million loss, it's a 66% co-insurance penalty. What you're saying is a third. So your $1 million loss, you're not going to get covered at $1 million. They're only going to cover 66% of your loss because you have to pay the penalty. So they take a third of it away from you. So you would only get $660,000 in insurance proceeds. You already had a $500,000 deductible, so you're missing out. So you're only going to get $160,000 from the insurance company on your $1 million loss. So if you didn't have that co-insurance provision, or you were fully insured, you would have gotten additional $500,000 in proceeds. So, or not additional, you would have got $500,000 in insurance proceeds. So the co-insurance provision cost you $340,000 in this example. And obviously this number gets much larger if this were to be a total loss or something like that, or a very significant loss. So you definitely need to understand how co-insurance works and that you're in compliance. So this is a big one. Everyone wants to know, can we reduce our rates? How can we fix up our building? What improvements can we make? I have seen some buildings that were able to switch out all of their windows and doors and access points to impact glass, update their roofs. Do those things reduce the rates, Paul?
Yes, they do, for sure. As you mentioned, where it's tough for a community to force the owners to replace all the impact glass, but in a case where it's a building and there's only a few that aren't impact, we have seen in some cases those associations are able to get that building fully impact glass, which brings a lot more markets into play, a lot more capacity into play. And when you have more capacity, you have more competition. Supply and demand works in your favor. It does have an impact on that. the roofs and the electrical panels, obviously, not to repeat myself, have a big impact on this. And again, be careful when you're shopping. And you got a liability quote from a non-admitted carrier that's half the price. I would bet you dollars to donuts that there's a lot of those exclusions that exist in that policy, in that quote. And if the agent isn't transparent, you're going to find out when you present a claim and they write you a nice letter that says you're not covered.
Right. Yeah. So if you can, I have seen some attorneys get a little bit creative with kind of mandating improvements on these very old buildings where, there's a few people left that may not have impact glass. But it's very expensive. And if you have to do your common areas could be extremely expensive alone. So it is a cost benefit analysis. Although the rates will come down some, are you going to get the value out of it when you've replaced all these windows and doors? So another issue on reducing rates, we'll talk to the HOA people on here, is the most of the HOA claims that we see are typically the general liability claims. They're the slip and fall, they're the sidewalks, they're the dog bites. You really need to pay very careful attention to your properties, walk your properties, try to identify these things before they become a problem. I can tell you the sidewalk trip and fall is probably the trendiest lawsuit in HOAs right now in South Florida. The problem is that even if you win that claim, even if you settle that claim for small dollars, when you go to renew, your renewal can be 25, 50, 100% more, Paul, right? I mean, even more in some cases.
Yeah. Insurance companies will look at, underwriting 101 is let's take a look at your something we call in the business a loss run. So let's take a look at your loss run, which is the last 5 years of your claims history, and let's see what that looks like. Because in the history of insurance 101, your past performance is the best indication of what is the future. And unless we have a really good story to tell these insurance companies as to why this is going to change, this becomes gospel when it comes to pricing or even whether they're going to offer terms. And in a limited market where there's not a whole lot of carriers that want to write this, you put yourself in a bad position. And I will tell you, here's an opportunity for an agent, a good community association insurance agent, to show some value to their community and put some risk management in place, put some controls in place, help the community do this as a risk manager. And it's things that you just mentioned, form a committee of residents or board members and use checklists, safety checklists, to make sure that that the community is safe, that the sidewalks are free from trip and fall hazards like roots making the sidewalks uneven and things that could cause hazards, and documenting that. Because if there is a claim, you want to be able to defend yourself as much as you can, but you also want to show these underwriters that you're proactive and you're trying to maintain and create a safe communities where you don't have incidents.
And these sidewalk repairs are expensive. Do not be penny wise and pound foolish. I see these bills come in, they're $30,000, $60,000, $75,000 to address all the areas that may need to be addressed. I can assure you, if you have one of these incidents, even if it's not very serious, your next insurance quote will probably be at least that much higher. And then it'll remain high for a few years potentially. So
yes,
you may spend that money 2 or 3 times over on insurance and have to repair, the issue that caused the problem in the first place. So even though these repair bills look high, you'll pay more in insurance if you don't address the problem.
Yeah, and big deductibles that are put on there, exclusions that we can't negotiate off because we have no other offers. I could tell you horror stories.
Right. So be proactive in your communities when it comes to safety. And the other things we talked about. So I know everyone wants the state to come in and help, and they actually have done a few things that are making a bit of a difference. So what's going on at the state level that's potentially helping with insurance?
So recently there's a few bills that have been passed. So the first one is Senate Bill 7028, which essentially could provide another $200 million in funding for the My Florida Safe Home program, which grants up to $10,000 to homeowners to make improvements for wind mitigation. So this is really pertains to the homeowners associations because it's for personal homeowners insurance. But it's still good for commercial property insurance rates. And I think it's just kind of positive sentiment for the market. And then House Bill 1029 was a bill to create a similar program, but for condos, called the My Safe Florida Condominium Pilot Program. And this will grant up to $175,000 overall, or up to 50% of each project cost for wind mitigation improvements. So that's something that, should be really good for condominiums specifically, and getting those, old roofs replaced, impact glass windows, just certain things that, are big problems right now. And then House Bill 7073, it was passed to reduce property insurance premiums by $500 million statewide through the elimination of certain taxes and fees. And this isn't a whole lot when you take into account, the whole state, but it is something, and it's, the state is, they're doing something to help. And all of these bills are passed and set to take effect July 1st, 2024.
All right. And not to get everybody's hopes up, the Mack, that HB 1029, I think there's a cap on that program that's pretty low. That's not an unlimited program. It's not on here, but I don't think there's going to be a lot of access to that, at least initially. We'll see if they change it. But at least they're trying. They're trying.
Yeah, probably worth mentioning, Evan. The state was widely criticized for not doing enough when all of these roof lawsuits started happening a couple years ago. They did pass there was an emergency session, and they did curb the lawsuits that are on roofs, but it's only to a select number of carriers. So they did try and do something there, and hopefully that it'll take a while for that to get traction, but hopefully that too will continue to aid improvement here.
Right. Okay. So, how do we communicate with our residents? I mean, no one likes to hear this bad news about insurance, but the market is what it is, and the state is not going to be capping rates or anything like that. There's not going to be any heavy-handed fixing of pricing. So what do we do? You have to get the word out early and often. You should be reaching out to your agent if you're not hearing from them, to make sure they're getting you the information you need as soon as possible. If you're expecting a large increase, if you're in a condo and you may have to assess because of the size of the increase, get the word out early that this is coming. Help people prepare financially. It's not your fault as a board that the insurance rates are going up, but it is your fault if you aren't communicating with the residents. So don't be afraid of delivering bad news. It's just going to make the problem worse. When you deliver the bad news, have the professionals deliver the message. Paul, Chad, other agents, they do get paid for these policies, and they are certainly willing to commit their time to explain what's going on. You've heard today how knowledgeable Paul is about the market, about what is a good rate, what's not a good rate, what's happening with appraisals. Let the professionals answer the very difficult questions that your residents rightfully have about what's going on out there. You don't have to try to learn all this yourself and then regurgitate it to your homeowners. They'll be more than happy to come in and do that for you. And if they're not, then they may not be the right agent for you. And the bottom line is, we do need to take a step back and realize condo property insurance, is still a good deal. This example is a year or two old now. These numbers have probably gone up, but the principle is the same. To have a beachfront, waterfront condominium in South Florida, you're going to be paying about 1/4 to 1/10 the rate of a similar single-family homeowner with a similar location. It is still a good deal to be sharing all of this insurance with your neighbors. You are not being hit nearly as hard on the condominium side as a single-family homeowner to live and work where we do. So please do keep in mind that relative to prior years, the costs are high, but relative to the alternatives, condo insurance is still a good deal where we're at. So I think at this point, We do have a little bit of time for Q&A, so I'll try to filter through these and we'll answer as many as we can while being respectful of everybody's time. One exclusion that somebody brought up that I'm not familiar with is a cross suit exclusion on their GL. Could you explain what that is? And is that a common exclusion, Paul?
Sure. So cross suits. So sometimes we have multiple associations that are sharing the same insurance policy. And when an insurance company puts a cross suits exclusion on there, that eliminates the risk for the insurance company of one association suing the other. It's a bigger issue on D&O. It is fairly common to see. And it is a bigger issue on D&O, which is why you would never combine D&O policies. Every entity, every association should have its own D&O policy whenever there's a board, not including like a committee or something. But if there's a separate entity, we oftentimes see sister communities that buy insurance together to kind of leverage it all. That's fine, but not the D&O world.
Right. How many carriers would you estimate are writing condominium property insurance right now in the state?
Well, I think the right question is how many carriers are writing that are real markets that are really competitive. That's because there's a lot of companies that say, "Oh, we write," but their rates are just so outrageous that I don't even count it. Okay, so like real markets, I would say there's probably 6 or 7.
Okay. Is wind insurance mandatory for the association? We believe absolutely that it is. If you're going to do anything other than that, you need to consult your association counsel, please, before you make any decisions like that. Let's see here. What's the range of premium increases you're seeing this year on wind, property insurance for condos?
So that range, like we talked about, depending upon your roof age and condition and your appraised value, and all of those factors, can be anywhere on a low end of 10% on up to, on average now, 25%, 30%.
Right. Are you seeing issues with lithium battery fires? And have you seen any of those type of claims in condos? And is there anything they can do? I've not seen any claims related to those fires, but
no, I haven't. It's I mean, we see it on the news and you see all these things, but it hasn't really had a major impact on insurance for our discussion here today.
Okay. Are there companies that'll come out and do a safety review, or maybe the insurance carrier do a safety review of the property?
Yes. You don't want the insurance company to go out there and do that. That's like asking the IRS to do your taxes. So again, I would think that an agent that could show value could assist an association with a safety inspection, and helping that association create committees and giving you guidelines to make your community safer.
So Jane asks, on the animal bite issue, can we require owners to carry their own animal insurance? That's more of a legal question, and it would probably depend on your documents. I would say it's a great suggestion, and I would consult your attorney for your property based on your documents, if that's a rule, or perhaps you would have to add an amendment. But it could be helpful. Absolutely.
Yeah, and you said it, Evan. The associations in the crosshairs, they're a deep pocket. The lawyers are always, it's a great suggestion, but the association is always going to be sued because that's the plaintiff lawyer's target.
Right. There's several questions here around the same theme, which is if these breaker panels are in the individual units in the condominium and not just the common areas, are they still the issue, and can they be forced to be changed out even though they're in the unit?
Yes. And we understand, and the insurance companies understand that that's not the association's responsibility, but it doesn't change the risk, and the insurance companies want them out.
Right. Okay. Someone asked about the electrical panel issue applying to single family homes in 720. That's all related in a single family home. If you're subject to 720, that would depend. You're buying your own insurance for your own single family home, and that would be between you and your own insurance carrier. It would not, the association's insurance carrier in a HOA is not going to care about what's in the individual homes. They will care what is in the clubhouse, the guardhouse, other common areas. So you may have to replace those in the common areas where you may have older panels, but it wouldn't apply to your individual residence. So that'd be between you and your private carrier. Let's see here. Someone asks about could you expand a little bit on what you mean by a not properly insured contractor and the warrants? Is there a certain amount of insurance we should look for, or is there a type of insurance they need to carry, that sort of thing?
Yeah, sure. So these warrants that have a varying degree of limitation. Some of them that are less restrictive will say that they're going to require your vendor, your landscaper, anybody that's coming on the premises, if you're restriping the parking lot, for example, or like we talked about, doing the roof job or something like that. Those contractors carry $1 million, generally $1 million liability policy, including product liability. And if you don't comply with this requirement, they have the ability to charge you an additional premium. That's the very best case scenario. The very worst case scenario is they put a requirement on there that a sophisticated risk manager from General Motors would have a hard time understanding. And if you don't comply, they don't have any obligation to pay. If something were to happen and the contractor, some debris fell off the roof that they caused and caused injury to somebody or property damage to someone's vehicle, and they went after the association for that, the insurance company would have no obligation to pay. So it's always a good idea to make sure that the contractor or vendor is licensed and insured. And here's another opportunity for a good community association insurance agent to assist the community in making sure that complies. And hey, we need to make some changes to the policy or to the quote to add you as an additional insured. All these factors, you shouldn't go that alone. But boy, if you have a warrant on there that's restrictive, that's not good.
We had on the slide, we did kind of skip over. Could you mention what EFIS is and why it's leading to declinations, non-renewals, that sort of thing?
Yes, it's an exterior finish. Exterior finish that's insulation. It's basically like a styrofoam in place of the stucco. And it was common in the 1980s, and a lot of problems with water intrusion and those types of issues. So insurance companies try and stay away from this as often as they possibly can, because it presents a risk. It's kind of like a construction defect issue that could drag the insurance company into having to pay water damage claims.
Gotcha. Okay. Well, a couple people mentioned, my example was, they're paying more than my example. That's one example of one condo. Age, roof type, impact glass, all those things are going to make a big difference on what you're paying. And it's that reference is probably a little old now. So the bottom line is, no, not every condo is going to pay the same per unit. That condo also has a lot of units, but in general, it's still going to be a better deal typically. But if you have a much older building or you don't have impact glass and those sort of things, you may be paying more. So you do have to, take into account the age and quality of the building and the materials and everything. So, all right, at this point, we're a few minutes over. We have, I want to be cognizant of everybody's time today. So I'd like to thank Paul and Chad for joining us. I do wish we could get to all the questions, but it's not possible. So Paul, any parting words here today?
Yeah, Evan, we covered a lot of material, and I think one of the biggest takeaways here that we talked about is shopping insurance, and we certainly have the experience, the expertise, and that's one of our greatest values to a community. So we certainly don't have a magic bullet where we can create a carrier out there that's going to cut rates in half, but go out there and get a second opinion. If you're looking for an agency that's very transparent in the way we do business, can give you a second opinion without any obligation, we're happy to do that and would be grateful to have that opportunity.
Thanks, Paul. Yeah, and we're happy to give you guys advice in any way on management and that sort of thing. Another issue that's coming up with both insurance and the structural integrity reserve studies milestones for you condo customers is budgeting. That's another area where we have a lot of expertise, and all of these things are intertwined. So please don't hesitate to reach out if you need any advice on management services. So at this point, I think we're going to call it an afternoon, and we look forward to seeing you all again here on future webinars. Thank you for your time, and see you all again soon.
Thanks for watching. For more great educational content, click the subscribe button now.